You're listening to the Money Monopolizers podcast, helping you take control of your financial destiny. It's about time that we invest more in our financial literacy and work towards building generational wealth. If you think you're ready to do the same, then you've come to the right place. Alex, Marlon, y'all ready? Let's get this bread.
What's good, everybody? It's Alex Comunio here. We are back with episode 17. I'm here with my co-host, Marlon Walls. Marlon, how you doing today, bro?
Man, I'm actually doing really good. It's been a very busy week this past week, but I'm also really excited. I think it was really rewarding because we closed on another deal back in Houston. We had a duplex that we closed on. It's going to be our another rental property added to our portfolio. I think we've done a lot this year as far as building our business. I think it's only going to grow from here. So how about you?
Oh, yeah, definitely. That was we just closed on that one, I guess yesterday now, when y'all hear this. I think it'll be a great addition to our rental portfolio. Our business is starting to really take off right now, and it's really good to see, and it's really rewarding to see every day. You know, you've been able to see the fruits of your labor day in and day out. So, you know, I'm super excited about that. We got that one out there. We got the flip that we're continuing out here in San Antonio. This is, like we said, the most intensive flip that we've undertaken. And it probably is the most intensive flip like that we can undertake. It's because it's literally like a full gut. So, but you know, it's going. We've run into a couple issues, but we'll fix it and, you know, be on our way on that one. But, you know, overall, you know, I can't complain. I'm real happy with where we're at. And, you know, I just been really focused on these things, on this business, and really trying to also grow this podcast and spread our message out more. Because, you know, when we started this podcast, our mission with it was, you know, to help people really take control of their financial destiny, teach people about personal finance and investing in business and all these things. And, you know, the mission is still the same. But that being said, I think there's a little housekeeping that I want to, you know, take care of before we get into this episode. I mean, like I said, our mission with this is still the same, but we really, really, really want to grow this. And get this message out to more people, just because it's that we think powerful of a message. And for us to do that, you know, we really need y'all to, you know, to share this podcast and especially leave things and reviews on Apple Podcasts if you're listening on there. Because honestly, we have about 200 listeners that listen to us, you know, week in and week out. And, you know, we are truly thankful for y'all that are continuing to listen to us and continue to, you know, come tune in every week to see what we got to say. So we appreciate that. But, you know, if everyone that was listening to this podcast, you just take a moment and give us a rating, we'd really appreciate that. Because, you know, we spend a lot of time and effort outlining and editing these podcasts, creating social media content, writing blog posts, you know, all these things that we're doing every day to really try to grow this. So if y'all could just take the time to leave, you know, a rating and review on Apple Podcasts, because honestly, the reason we asked for these ratings is not, we asked for these ratings because the algorithm to that the, you know, podcast hosts or the podcast website to use, like Apple Podcasts, the podcasts with, you know, the highest ratings, those are the ones that are, you know, displayed to people first whenever they search for podcasts or whatever. Whenever they're just, you know, seeing other podcasts to subscribe to, it's the ones that have, you know, good ratings and a good number of ratings, a high number of ratings. So the more ratings we get, the higher up we'll be in the query, which is going to ultimately allow us to spread this message to more people. So honestly, it takes 5 seconds for you to just, you know, leave a rating, a review. And, you know, if we appreciate it if you did that right now, we'll even give you 5 seconds to do it right now. We'll wait for you. So yeah, that's that. We appreciate if you you know, able to do that. Anyways, the next thing that I kind of want to talk about was something new that we are starting on Money Monopolizers as far as content. So there's you know, the Instagram and YouTube is so powerful, and we really want to, you know, try to grow that side of things. So what we're gonna do now every week is I'm going to be starting a series of something I'm going to be calling Whiteboard Wednesdays. So in a sense, I'm going to be, you know, just pretty much writing on a whiteboard and teaching a topic in regards to the stuff that we talk about, personal finance, investing, financial freedom. I'm just gonna be using the whiteboard to teach a topic. It'll be a 5, 6, 7 minute video, nothing long like a podcast, of course. So, just something for people to, another way for people to engage and reach another audience of people on YouTube and also on Instagram with IGTV and those things. So yeah, so that's going to be something we're going to be starting. If you are here, y'all are hearing this. So either I released the first one yesterday or the first one's coming out next week. It just depends if my equipment gets here to whenever we're recording this, which is, in the past. But if my equipment gets here today, then I'll be able to do that today whenever it gets here. But if not, I'm going to just do it next week, and the first one will release next Wednesday. And then the last thing I kind of want to touch on is something else that we're going to be starting. I'm not going to talk about it too much here because we're going to talk about it later, but we are going to be, in a sense, starting a venture capital company. So, yeah, we're going to talk about this a little bit more in the episode when I kind of get into the meat and potatoes of this episode. So definitely look out for that. But yeah, let's get into this episode. Marlon, do you have anything you want to add before I moved on?
No, but I definitely like the idea for Whiteboard Wednesdays. I think that's going to be another way for you to interact with us, for you to see different aspects of what we have to share with you. It's not going to be a podcast format, so it won't be these hour-long podcasts. It'll probably be a 5 to 10 minute little info session where you can learn any type of financial topic. I would also suggest if anybody has any topics that they want to see covered, you can also mention those to us and we can go over those as well.
Yeah, definitely. So yeah, let's get into this episode. So today, episode 17, are going to be kind of finishing up our real estate series. So this is part 6. We were talking, last episode we talked about I don't even remember, what did we talk about?
Last episode we talked about analyzing deals.
Yeah, okay, yeah. Analyzing deals. So yeah, we're going to build off of that and talk about financing deals and the money, right? No money, no problem. So that's what we're going to kind of get into this episode. And the way we kind of ended last episode, we did an example with 20% down. If you saw that episode, didn't go check that episode out and listen to that. But we kind of did an example with 20% down. And I mentioned at the end of that episode that, whenever you're putting 20% down on houses, you're not getting as best a return as you can possibly be getting, right? Because what is return? ROI is benefit over cost. It's what you're earning over what you put into it. So that's the equation. So in order to increase your ROI or your return on investment, you have to either, increase your benefit or your profit or decrease your costs. When you have invested, the worse your ROI is. So because we are teaching here, what we're going to do this episode is talk about a few of the financing methods, and even the ones we wouldn't use, just so that we can cover as many bases as we can for all our listeners, because, everyone's in different situations. So, each of these methods that we're going to talk about, I think, in a sense, you can consider like a tool to your tool belt. It's gonna make you more versatile, even if you never even use them. It's good information to know and have in your back pocket. Because you never know what's going to happen in the future. Creative financing is a thing. So, yeah, let's get into it.
Yep. No doubt about that. But I also want to reiterate for people who don't know already. I know he kept saying 20% down. When we say 20% down, we're referring to putting a down payment on a house or any real estate property. So say if you have $100,000 house, you had a 20% down means you're putting down $20,000 of that $100,000 as a down payment to take ownership of the home. And honestly, that stems from the reason we're having this episode in the first place, because most people don't have $20,000 in their bank account. And so they feel like that's a barrier to entry to where they never want to even get started with real estate in the first place. So honestly, I see a lot of people who are interested in real estate but don't have the funds. So what they always say is, I'm going to become a wholesaler. They want to become wholesalers because, as a definition of a wholesaler, that's somebody who finds a deal, doesn't have to actually put any money into it. What they do is they find it at a steep discount and sell it to an investor, to where the investor actually purchases the contract, and then basically the wholesaler makes a wholesale fee. So the wholesale fee is like equivalent to like $5,000 to $10,000 usually, of where the investor is paying you to find the deal, and you just take that little $5,000 to $10,000 wholesale fee, and that's like your first intro into investing. So that's how you make money without having to put any money down to get into a deal. The problem with this is that there's the most competition in that field because everybody thinks the same way starting out. Is that, oh, I don't have any money, so let me be a wholesaler. You don't need any money to do that. And that's exactly why we want to have this episode in the first place, because people automatically think that's the only way that you can get into real estate without any money. And there's actually many other ways. So I actually want to give a quick plug out to the book. If y'all are looking at this on YouTube, you can see the book. It's called The Book on Investing in Real Estate with No and Low Money Down by Brandon Turner. As you've probably heard before, that is one of the Bigger Pockets. He's actually the host of the Bigger Pockets podcast. We mentioned him before. We won't go into much in depth, but that he teaches a lot of stuff that we'll be teaching today in this book. He'll go a lot more in depth than we will during this episode. But overall, we just want to show you other creative ways in order to finance deals that you're usually not taught at home or in schools. And just want you to understand that you don't have to be born rich in order to start investing in real estate.
Yeah. I'm cutting it out, but
why are you cutting it out? Because the stuff that we cover in the book stuff we cover today is in the book.
I was just playing.
Okay.
But so yeah, like you said, there are various ways to finance deals, and one of the first one we're gonna get into is it's cash, because cash is the probably the simplest way to finance a deal, but in a sense, it's also the one with, the largest barrier to entry, because most people just don't have cash like that. But the reason I want to talk about cash isn't necessarily to cover how you should buy with cash. It's, to me, I want to cover why cash is not a good option, honestly, or why I don't think you should buy properties in all cash. And I know, most of our listeners aren't going to buy with all cash, but in order to understand, I really want you to understand the theory and the concept behind what happens whenever you are, in a sense, not leveraged. Because for me, in real estate investing, the most powerful thing within real estate investing is leverage. Someone asked if we can talk a little bit about leverage. Someone DM'd us and asked about that. And I think I'm going to touch on it a little bit here just because it does tie into what I'm talking about. But leverage is the most powerful, thing within real estate investing, like I said. And when I say leverage, all I mean is that you have a loan on the property, right? So the bank has leverage on you. So you're buying at leverage. So if you have any debt on the property, any mortgage, or you owe anything, that means you're leveraged. So remember the four wealth real estate. Well, you can honestly add leverage as the fifth one. That's how powerful it is, in my opinion. Because the thing about whenever you pay all cash, paying all cash affects all of those wealth generators. Especially the number one thing it affects is your cash flow. So I say that, real estate is the only investment vehicle where you don't have to own 100% of the asset, but you still reap 100% of the income. So I know we talked about last episode when I said we'll talk about how to avoid paying, 20% down. But I want to just consider that again in order to make the argument of why using cash is not beneficial for you in terms of like growing your real estate business. So for example, let's say that in order to demonstrate this, so let's say that you have $100,000, right? And there's 5 houses that cost $100,000 each. So instead of you just buying one house and owning it free and clear without a mortgage, you pay all cash for it. You should take advantage of leverage. So you should, in a sense, what you should do is purchase each house with a 20% down payment. So now you own $500,000 in assets while each one are being paid off by tenants. Each one is appreciating and each one is cash flowing. So that is the beautiful, most powerful aspect of real estate, because there's no other investment vehicle that allows you to do something like that. And let's look at the ROI just, to demonstrate that cash, buying a house all cash versus putting leverage is significantly better on, in regards to your returns. So if you bought a house all cash, and let's say you can rent each house for, let's say $1,000 a month, and you're going to get it at 4% interest on a loan. So, and you can just use any value for the taxes and insurance. So if you were to do the ROI equation, benefit over cost, you would take your 1,000 times 12 and subtract that from, or let's say for the all cash, for the ROI when you buy the house all cash, you'll do 1,000 times 12, and then you'll subtract that from the, yearly taxes and insurance. So you'll take your monthly taxes and insurance times 12 and divide that all by your 100,000. So that value, if you do that math, is going to give you 10.4%. So if you bought the house in all cash, your return on investment is 10.4%. Now, when you leverage 20% down and you do that same equation, now obviously your mortgage goes up because you owe 80,000 on the house. So now you can still, let's say you still rent out the house for $1,000 a month. So 1,000 times 12, and you subtract the principal, interest, taxes, insurance times 12. So now you divide that value by 20,000 now, because that's how much you have invested in the house. So when you do that equation, when you solve that equation, you get 28.8%. So your return is 18% higher. It's almost 3 times the return you're getting whenever you buy the house all cash. That is the beautiful thing about leverage. So I never ever recommend anyone buying, any properties in straight up cash. Even if you have the cash, leverage it into multiple properties. Obviously diversify, into different investment vehicles, if you will, do that too. But leveraging it is the powerful thing. I look at it like this, bro. Cash makes you rich, but leverage is what's gonna make you wealthy. So always think of it in that aspect, right? Cash is, you can have cash, you can have the liquidity, but that doesn't necessarily, catapult you into, any wealth. Leverage is what catapults you, because you're taking other people's money and you're still growing and you still own 100% of the assets. So that's the beautiful thing about it. So yeah, always remember that ROI equation, benefit over cost. You decrease your cost, you increase your ROI.
I love the example you give, because a lot of people love the thought of owning something free and clear. Especially like if you spread your wealth over multiple assets instead of trying to put it all into one, so you can just cash flow off of one unit. Now you get to get more return for your money from each unit. So if you get like you said, just to reiterate what he was saying, if you put all of your money, so $100,000 into one deal and just rent it out for $1,000 a month, it may meet the 1% rule. So I know we mentioned that before, 1% rule. It may meet that, but you're not getting the most return on your money that you could possibly do. So that's actually a term called return on equity. So you have $100,000 of equity, but you're not getting the most return of that. Like you spread that out over 5 different units, like Alex was mentioning. Now you get the maximum return possible for the money that you're putting out. Now you can have $5,000 of gross income and then subtract out all the expenses instead of just $1,000 of gross income. It's just that's the power of leverage. I just want to reiterate that.
Yeah, and like I said, it affects all your wealth generators, right? It affects your appreciation, your cash flow, your taxes, and your loan pay down, equity buildup. And because you think of it in every aspect. Whenever your house, if let's say you had $100,000 house and you bought it in all cash, you have $100,000 invested, and then it appreciates to 110. Now that's only a 10% increase in wealth. But if you had $100,000 house, it appreciates to 110, and you only put 20,000 into it. Now that's a 50% increase in wealth, because you had $20,000 invested, but now you still got that same benefit of appreciation. So now you see it affecting your appreciation, you see it affecting your tax benefits. If you can't deduct mortgage interest and off of your yearly cash flow if you have it
on it free and clear.
Yeah, exactly. So now you're affecting your tax benefits. You're not being able to take advantage of that wealth generator. If you don't have, if you buy it all cash, it's affecting your loan pay down and equity build up too. Because the beautiful thing about, especially rental property, is the fact that the tenant is the one paying down your loan. You're not paying the loan, so it doesn't matter. Why would you pay off the loan whenever the tenant will, right? So in essence, it's like asking, would you rather you pay the full $100K, or would you rather let your tenant pay 80,000 of that amount? So, it's a rhetorical question. Obviously it's the latter.
That's a difference in mindset. That's perfect though.
Yeah, definitely. So that's kind of what I want to touch about on all cash. I'm not necessarily saying to go use all cash, but that like concept behind using all cash, I just kind of wanted to throw it out the window because I really don't see the power in it, especially with real estate investing. So anyways, let's move to like some of the, I guess, other ways of financing properties. The other one that we kind of want to talk about and touch on too is conventional financing. So we've talked about this before in episode 13 when we talked about building your team, when we talked about the lender. We talked about conventional financing, but we're going to touch on it a little bit more in detail here just because, there's a lot more to know on it. So conventional financing is, like we said, it's pretty much a loan that you're going to get from like a local bank, a credit union, or a mortgage lender. So these institutions typically only lend on homes that are going to be move-in ready. They don't lend on any houses that are physically distressed, and that's the main reason we don't use them, because there's no potential to increase value in homes, and what we do is value add. So whenever you buy turnkey houses, you can't increase the value on them. And also with these conventional lenders, another reason is because banks or these lenders typically require 20 to 30% down on investment properties. So this is, it's usually depending on the strategy, you can, it's as low as 3.5% for owner occupied, but investment properties is 20 to 30%. So, excuse me. And that's in addition to the fact that you have to, have credit worthiness. They're not just lending to anyone, like some other type of lenders, right? They look at your DTI, they look at your income, they look at all that. If you want to know more about that, you can reference, we talked a lot about, how to improve your credit and all that in episode 7. To make you a more credit worthy person, right? These conventional lenders, they also usually have low interest rates. At the time of this recording, I'm not sure, don't know if you're listening to this sometime in the future, many years in the future, interest rates could be way different. But right now, investment property interest rates are, about 5%, maybe even a little lower if you get good terms. But those are a few things that go with that. A couple other things that you should know about conventional loans are that you can only get a maximum of 10 of them. You can't go past that. That's a rule set by the national government. Because at that point they see that you probably might have too much DTI or whatever. And most investors can never even get to 10 because they usually get to like a few and their DTI becomes too high. And now the bank is like, well, you have way too much debt based off of the income you're getting, because you still only have that one job or whatever you're getting, but you're still trying to buy property. So from a bank's perspective, even though that you have a tenant paying it, they still, and also the process is super slow whenever you want to go conventional financing. It's not nearly as fast as any other type of financing. So what we kind of going to do is just talk about how what we're kind of going to do is talk about how conventional financing kind of does work. Sorry. So the first thing that I wanted to touch on was that, I want to explain the process a little bit. So pretty much the way it works is, if you wanted to go get a conventional loan on an investment property, you would just go to the bank and ask for a mortgage, and they're going to pretty much decide if you're worthy for it. So if you are, the lender is going to create a mortgage for you, also known as origination. So then they're most likely, what they're going to do after they originate the loan, they're most likely going to sell that loan they give you to what's known as a GSE, a government sponsored enterprise. So these are Fannie Mae and Freddie Mac, right? These are GSEs created by the government in order to literally purchase loans from lenders. So either they'll sell it to them or they'll sell it to an investment bank on the secondary market so that they can IPO and sell mortgage-backed securities and all that. But Fannie Mae and Freddie Mac are the GSEs created by the government for the sole purpose of buying loans. So that's literally, most of the time, if you go to a bank and you get a loan, they're most likely going to sell it to Fannie Mae and Freddie Mac, and now you're paying the government money. And the bank just, in a sense, became the middleman. And that's actually one of the, causes of the market crash in 2007. I'm not going to get into the details, but pretty much, banks were just getting out too many loans to anyone, subprime loans mainly. And then pretty much the market crash. If you want to know more, I can, talk about more. That's a little bit beyond the scope of this. We could even do an episode on that in the future on what caused the market crash. So anyways, but after the market crash, the requirements to get a loan became a lot more strict. So now, before they were giving out loans to anyone, but now you had to really be credit worthy now to get a loan. There's no subprime loans anymore. So if this is something that you think you do want to do, if you are in a position to put 20% down and you are in a position to do that, then I'm going to kind of just go through a few of the steps that are going to happen whenever you do, or a few of the things you should do whenever you are trying to get a conventional loan. So the first thing you should do is shop around. So that's pretty much you just calling 3 to 5 local banks, credit unions, mortgage lenders, and just asking them. You're just asking them like what loans they offer, or like the different type of loan programs, for investment properties, their rates, terms, etc., all that kind of stuff. That's what you're asking. After that, you pick one and then you get, pre-approved. This is pretty much getting the bank to say, yes, you are credit worthy. I will lend to you. So this is when they're going to really be looking at your credit worthiness. So if they say yes, then you'll go find your property that you want to buy and you'll submit the information about the property to them. This is pretty much, you'll just give them like a purchase and sale agreement. CMA, which we talked about in the last episode, like those are just comps, any contracts, etc. So you're just submitting paperwork on the property. After that, the lender is going to they're going to say you have to pay for an appraisal on the property, and that appraiser is going to go to the property and tell the bank how much they think that house is worth, and that's just pretty much so that the bank doesn't loan more on the property than it's worth. And also they want to verify that the property is in good enough condition for them to lend on. So if it is, and they're good with all that, then your loan will go to underwriting. So this is where they'll decide if they want to actually loan on this property. So there's underwriters that work in the banks that actually literally just look at, different loans all day. So if they decide they want to do that, then your loan will close and you'll bring a check for the down payment and the closing costs, and that lender will wire that money for the purchase of that house. So that process itself does take, I just outlined it really quick, but that can take very long depending on, the type of property. Especially if it's a REO, or a real estate owned property, that's like a foreclosure or, an auction property or something like, or not auction, like a foreclosure. Those properties or short sale, oh my God, those will take forever. So that's probably one of the downfalls of conventional financing. So yeah. So the last type of conventional, financer, or the last type of conventional financing is a portfolio lender. This is pretty much, and I'm gonna just touch on this real quick. A portfolio lender is similar to a conventional loan, but it's a lot less strict, right? So since conventional lenders are selling their loans to GSEs like Fannie Mae and Freddie Mac, they have to abide by those rules set by the government. They can't, just give a loan out to anyone. They have to say, okay, we can only lend to these people that meet these government, rules. So, but the difference between a portfolio lender is that portfolio lenders don't sell their loans after origination. They keep them in their portfolio of loans. That's why they're called portfolio lenders. So they keep them in-house. So they can really set their own rules because it's their own money that they're going to keep. So they're going to be a little bit more flexible on your DTI, your number of loans you can have, and maybe even the down payment. Obviously, you still need, good credit and a good size down payment, but, they are a little more flexible on those kind of things just because, like I said, it is their money. So if you want to find a portfolio lender, you can easily find them. They're typically those, small community banks with, a few branches in your city. There might be a credit union. It might be, any bank that just is just local to your area. Those are typically portfolio lenders that don't sell their loans to the government or, investment banks.
Yep. And just to comment on that, portfolio lenders are definitely the ones that you want to go to out of the first few that Alex mentioned. I know he went through a few of them. He went through cash, conventional financing, like with big banks and credit unions. Well, big banks, and then he talked about portfolio lenders, which is like the credit unions and small community banks. So those are all ones that are probably going to cost you more to come out of pocket. Like he said, you might need higher down payments. and you should probably need more money out of pocket just to get started up. But now I think we should let's transition a little bit more into the types of finance that can like increase your ROI and allow you to get into deals without as much money out of pocket. Because for most of our listeners, I'm sure that y'all don't have 20% down to put on properties or even say 10 to 15, 20%. So we need some more creative methods to where we can actually get into deals without having a whole bunch of money, but we may have, say, drive, or we may have time. I know Alex said you need three things in real estate. You need hustle, hustle also goes with knowledge. You need time, and then you need money. If you need at least two or at least one of those three in order to have a successful real estate business. So I want to start off talking about hard money lenders. So this falls into the category of a private money lender, except that hard money lenders are, like Alex has mentioned before, they're institutionalized, and basically they lend on a hard asset as opposed to looking at you personally, like your personal financial situation, like your credit or how much money you have in a bank. So if they're going to look at the property that you're trying to obtain, because they've probably been, just because they've been investors themselves in the past, they know what a good deal looks like. So if they think that's a good deal, they will lend to you based off of the deal that they see. So with that, most investors use them for, say, flips or any type of rehab deal that they're going to turn into a rental property. So you can finance a rental property, like we're actually going to do this with our personal, the one we just closed on yesterday, I guess, if this is coming out on Thursday. We bind it with hard money, and once we're finished with it, it's because hard money is usually short-term loans, like 6 months to 12-month loans. You can pay it off early. Some people have a early payoff penalty, some don't. But you pay it off early by refinancing. Finance is basically going to a normal bank and saying, hey, I want to get a loan to pay off my other loan on this house. That way you don't have to pay the high interest, because most hard money lenders usually charge higher interest, say like 12, 15%. And that's something that you don't want to be in for a long term. So you refinance to a lower interest over a longer term, so like 30-year amortization loans. And hard money is just useful in order to get into a deal. So I actually want to give an example of how hard money could work when you get into a deal without any money out of pocket. So let's say you have 213 Main Street. I know, like Alex said, everybody lives on Main Street. It's a single family house. And let's say the list price is $90,000. And so as an investor, you are automatically, you want to try to get a discount, because more likely than not, you're looking at a fixer upper, not something that's turnkey. And you want to see if you can get a discount off of market price. So let's say the ARV is 120,000. So that being said, 120,000 ARV, most hard money lenders lend at 75% of the ARV, of the after repair value. So at 75%, that means that they will only loan you $90,000. So if the asking price is $90,000, now I have to tell me how much are the repairs going to be. So let's say you go into the house and go like scope it out with a contractor to see what work needs to be done, and you realize that you need $30,000 worth of work in order to get it to appraise at 120,000, to get it to appraise at 120,000. So that being said, I can't purchase the property at 90,000, put $30,000 of work into it, and then have it appraised for 120. It sounds like normal math, 90 plus 30 is 120, but you don't make a profit that way. You need to be able to get into the deal where you can be in for the project cost, which is the purchase price and the repairs for 75% of the ARV. We actually mentioned the 70% rule last episode. In this case, we're using 75% because some lenders will end up as high as 75%. So with that being said, again, if the hard money lender is only going to lend me 90,000 and I need 30,000 repairs, so I'm going to do 90,000 is the loan amount minus the repairs. That means I need to try to get this house for $60,000. So my offer to the seller would be $60,000, and that would be my goal to get that house for. I know some people are already thinking they're not going to take my $60,000 offer. If the property has been sitting there for say 4 months, they may entertain your offer. Some people may not entertain, but you just need to keep offering until the more times you get rejected, the more times the closer you are getting to your success where somebody will accept that offer. Because you never know somebody's situation. Somebody may just be ready to get rid of the property and they want to be entertained with an offer. So never let any rejection discourage you.
Mm-hmm. Yeah, exactly. That's a great little summary of hard money. I think hard money is super, super, it's a great way to get started investing in real estate. Especially because right now, hard money rates are pretty low. Just because economy is so good that there's money everywhere. So if you are looking to if you are looking to get started investing in real estate, hard money could be a great viable option for you because the rates are so low and it's, it's really not a lot of money depending on the deal. So you can really make it work if it is something that you really want to do. So definitely a good point. I think one thing also to mention is that a lot right now, a lot of hard money lenders are really they're doing 70%. But there are a few that are doing 75, but a majority of them are probably doing 70 right now. So if you can make the deal work at 70%, then it's probably a great deal. So just look out for that. At the time of this recording in 2019, that's kind of that's just how the economy is right now. The market's so good. So anyways, yeah, so that's hard money. So the next type of financing that we want to get into is private lending. So hard money is a form of private lending, like Marlon said, but that is institutionalized private lending. What I'm talking about when I say private lending is relationship-based private lending. So this is essentially whenever you're borrowing money from a private individual who is looking to make a return on the money they lend to you. So like I said, this is lending based on relationships. Each of these types of financings we're talking about has a different type of lending criteria, right? Conventional financing is lending based off of creditworthiness. Hard money is lending based off of assets. Private money is lending based off of relationships. So each of these, depending on how you want to go, you have to develop a certain, I would say, a different skill or sector of your total overall self, I guess. So yeah, this private lending is lending based off of relationships. So just to kind of, I guess I really like using examples to illustrate how things work. So I want to kind of give an example real quick without any numbers, just to kind of illustrate how private lending might work and how it looks. So let's say, for example, that there's a house I want to buy that needs a few $1,000s in some major repairs, right? So obviously the house needs major repairs. So the bank won't lend on this one. So what I can do is I can go to an individual that I've built a relationship with and ask them to lend on the purchase price of this house and maybe even the repair costs. So instead of me paying the bank a mortgage every month, I pay the individual interest every month until I either sell the house or I refinance the house, depending if I'm gonna flip it or rent it. And then I can pay them back their principal amount that they lent me. So that's typically how it works in the sense of private money lending. It's really simple and it's really a lot easier than any of the other types of relationships because it's in a sense you're using cash, but you're using someone else's cash. So it's still a great return for you.
I love private money just as a concept because this could really be anybody. It can be like your parents, grandparents, uncles, babysitters, third cousin. I mean, literally anybody that has money and that wants to get a better return than that 0.01% that I'm getting in my Chase bank account right now. Or it's like any other mediocre return that you may be getting from the stock market or your IRA. But I like private money mainly because it works in your favor. Like you get to negotiate the terms a little bit more. These are not like hard money lenders that have their set terms already. Private money, like I said, it can be a family member or anybody. So you can just tell them, hey, I can get you a return on your money. I can say I can get you 9% return. It can be whatever terms you come into agreements on. You can negotiate that however you see fit with whoever is lending to you. And I think it's very important to note that you don't want to lose their money though, because if this is somebody that you know personally, there's a difference between a personal relationship and a business relationship. And if the business relationship goes bad, that can really hurt your personal relationship as well. So I do want to say that you should definitely start with building your own personal knowledge before you take on talking to different private money lenders, because you are putting their finances at risk if you do not know what you're doing when you get into investing.
Yeah, definitely. You don't want to, I would definitely not say to, your first deal be private money lending, but if someone trusts you like that and you got the knowledge like that, then hey, by all means, but that's on you. But I kind of want to touch on, because a lot of people, you might hear this and be like, well, why would someone lend their money to me instead of just putting it in the stock market, their 401k, or even investing it in real estate themselves. And I want to kind of touch on that. So the thing to know about this, first off, is that either those people that are deciding to lend to you, they have some sort of financial literacy and know that they need to invest their money somewhere else besides their savings and retirement. They also know that diversification is a good thing to be doing in terms of their investments. So that's one thing that they already know right off the bat. Another thing also is that they want a better ROI than what they're getting from their investment vehicles that they're already using. And private lending is a form of investing. So the person lending to you knows that if they're going to lend to you, then no one's going to lend to you unless they know that you're credible and you're a trustworthy person that's going to get them a return on their money that's better than what they're getting wherever else they have their money invested. And I kind of want to go over like a few just to illustrate the types of returns that people get in their investment vehicles. The average interest rate for an IRA right now is about 6 to 7%. The average interest rate for the S&P 500, which is the stock market pretty much, over the last 60 years is 8%. Average interest rate for a CD, certificate of deposit, is 2 to 3%. So that barely covers inflation. So you're just covering inflation with that. The average savings account interest rate is 0.09%. So obviously this is the worst one. You're losing money, due to inflation. We talked about that in episode 3. So you can go reference that. But private lending, like, it's always based off of a relationship because it's whatever y'all negotiate. But that's usually around 10%. And I've heard as high as 12%. So, but like I said, it depends on the relationship. So that's the biggest reason people would be looking to actually private lend to someone else, right? They know that they can get a better ROI doing that than anything else they're doing. Another reason that they would do this is because of the security it provides them, right? Private lenders' investments are more secure with real estate than most other private lending investments. Because, for example, let's say they have money in the stock market and the company they're invested in loses 70% of its value. Or even better yet, let's say that they bought mortgage-backed securities in 2006, which, as you could guess, they lost a majority of that, if not all of their investment a few years later. So they had no control over that situation, right? Whenever you're in the stock market, you don't really have any control. So you just have to take that L if you take that L. But in real estate, if I try to pull that same kind of stunt and not pay the lender, then they can seize the asset, which is the house. It's, in a sense, they have, in most cases, private lenders get what's called as first position lien on the property when they lend. So that pretty much means that if you don't pay or oblige to the terms of the contract, they can take the property and sell it to get their money back. So that's the first position lien. They have first rights to that property if you don't oblige to, whatever y'all said. Same thing happens with hard money lending too. They have a first position lien on that because they lended you 70% of the value you needed. So they have first position lien. So that's another, huge reason that they might choose to invest with or private lend to a real estate investor. Another reason is that it's very, very passive. One reason they may not choose to invest the money themselves into real estate is because they don't either know how or they don't care to know how. That's not what they want to do. They just care about the money, the funds, the returns. They don't necessarily care about all the stuff that comes with real estate investing. So they're not going to be the ones that are going to be dealing with the contractors or the paperwork or the tenants. They're just the lender. So it's a form of passive income. They get interest payments every single month from you. So now those are the biggest reasons that, people might choose to private lend. And I think private lending is a great, great, great form of investing, especially with real estate, because you can just get so amazing returns because it's relationship based. It's really just, you have so much room to make it a win-win situation for both parties rather than just being something sold by the book. So what I kind of want to do now is just do a private lending example with numbers, just to show how the ROI is going to be better for you or me as a borrower of someone using private money. So let's say, for example, that there's a house for $100,000, right? And the rehab for it is $30,000 in order to give it an ARV of $180,000. So let's say I know someone that has $150,000 in an IRA and they want to get a better return. So what I'm going to do is I'm going to go to them, and because I have a track record and I'm credible, they're going to agree to lend to me. So let's say that the terms that we agree to are 10% interest only monthly payments and a 6-month maturity. A maturity just means that's when the balance is due, right? Mm-hmm. It's like a balloon payment in a sense, except for residential. So what they're going to do is they're going to put up the money for the rehab, and they're going to put up, let's say, 90% of the purchase price for the house. So now that makes their all in, or their principal amount, 90 plus 30, it's 120,000. So they put up 90% of the 100,000, which is 90,000, and then the full amount for the rehab, which is 30,000. So they're going to lend me $120,000. So what does that mean? That means I come out of pocket for the remaining $10,000 to purchase the house. Because remember, they only gave me 90%. So I have $10,000 invested, and let's say also another $3,000 for the closing costs. So total, I have $13,000 invested. So let's say the rehab takes 3 months, and it takes me another 2 months to sell it. So during these 5 months, I'm paying them 10% of their $120,000 principal investment, right? So 10% of $120,000 is $12,000. Divide that by 5 months, and you get $2,400. So I'm paying them $2,400 a month while I have their money. So that's their return they're getting. They're getting $2,400 a month, which is a great, income. So then when I sell the house after those 5 months total having their money for $180,000, I pay them back their principal $120,000, and I make $50,000 in gross profit. So this is, in a sense, this is a win-win situation, right? They made $2,400. They made $2,400 per month for 5 months by doing absolutely nothing. They didn't do a thing. They literally just gave me the money. I said, all right, appreciate it. I'm going to go do my thing over here, and then I'm going to pay you $2,400 every month. That's a great little side income. And that could be on top of what they're earning. That could be in their retirement. That could be whatever. Whenever they're giving me this money, I mean, that's great income. And I made $50,000 gross in 5 months. So that's a great, return for me. So that's a win-win situation for both parties. And that's why private lending is so powerful, because these terms can be negotiated to make it a great situation for both parties.
Yep, I love win-win situations, and definitely with private lending, even hard money lending, you can get a lot of these situations where you can get a win-win for both parties. And just to compare to conventional financing, imagine if you had to get 20% down for that $100,000 house, so that would be $20,000, and then you had to pay for the repair costs out of pocket. That's that $30,000 you had to pay in repairs. That's $50,000. So now you're looking at being all in for $50,000, and now you probably can't even get into the deal because I don't know how many people have $50,000 in their bank account. But instead, now you only need $13,000 to bring it to the table. That's at least something that's more manageable to get started with. And it just depends on how you structure the deal. So you can get in the deals for less, but that's actually at least more manageable. It's something you can save up for and work towards instead of $50,000, which may be unrealistic for a lot of people.
Yeah. So what I want to do is kind of look at my ROI based off of that, because I said private lending increases your ROI depending on how you're doing it. So let's say, like I said, I have the $13,000 invested, right? And I made $50K gross. So let's say after, all the fees and selling costs and holding costs, let's say I make $34,000 net. So my ROI, benefit over cost, is 34 over 13. If I do that, that is 161% return. 161% return. That is amazing for me as a borrower, right? So, and that's annualized if I just annualize it over 1 year. So that is a great return. And that's significantly better than anything you're going to get from conventional financing or all cash, especially because now my out-of-pocket cost is drastically less. And because it's a win-win situation for both the lender and for the borrower, who cares that my out-of-pocket cost is that low? It doesn't matter. It's just a great situation. And you might be thinking, well, I mean, that's great, but I mean, that's dope and everything, but where can I get a private lender? Right, these private lenders are literally everywhere. Actually, when I was doing research, it showed that a recent study from the U.S. Department of Labor and Training showed that 22% of Americans have at least $100,000 in their retirement accounts. So there's 154 million workers in America. So based off of that statistic, there's that means there's more than 30 million people with $100,000 or more that's either being facilitated through the stock market or collecting some sort of low fixed return in a CD or savings or some other conservative investment vehicle. So these people are literally all around you. You know what I mean? They're in the grocery stores, they're in the churches, might be in your family. And honestly, since we have about 200 people listening to this podcast, that means there's potentially 40 potential private lenders listening to us right now at this moment. So with that being said, I think this is a good time to introduce an opportunity that we've been, really diligently working on. So we are creating a venture capital firm called the Monopoly Vault Ventures. So our real estate business has been extremely successful so far, and so much so in a sense that we want to, help other people, or allow other people to join in on the success that we've been having. So what we're going to do is we're going to be providing investors the opportunity to achieve a better return on their money than what they've been getting in their IRA just by passively investing with us. So if you're a person, who has money sitting in a retirement account or savings or anywhere, and, if you've been interested in, and you've been looking into real estate, or you've been, wanting to get involved with it, or you've been even wanting to do some private lending, then this could be an opportunity for you. Because, we've been doing this for a couple of years, and as 23-year-olds, we've completed 6 real estate deals, which it's been a combined value worth upwards of $880,000. So it's been really, really successful. And we're working on closing, the 7th deal this year. So actually our most recent project that we did, it was a flip here in San Antonio, Texas, that we completed in 4 months. It was, February to June. And we listed it for 165, and we got 100. We had like 100 plus showings in the first weekend. We got 10 plus offers in the first week. And then we ended up selling it for $10K above our asking price for 175. So, that was a great deal. And if someone had private lent on that deal, they would have made a great, profit for those 4 months. We would have paid them interest only for those 4 months between February and June when we closed on it. And then whenever we sold on it, or when we sold it for 175, we would pay back, their principal amount that they invested. So honestly, if you think this is something you might be interested in, you could also check out more. You could check out our portfolio of deals that we have done on our website. You can go to www.moneymonopolizers.com/investments, and you can go look at, our portfolio of deals that we've completed. I'm constantly updating that whenever we are getting deals. So it's usually going to be up to date. So yeah. Honestly, even if you're listening to this podcast 3 years into the future, we're recording this in 2019, but if it's, 2022, whatever you're listening to this, then this opportunity is most likely still available. So if you are interested in learning more about this, you can contact us personally on Instagram at Money Monopolizers, or you can email me personally. And my email is alexcomunio@gmail.com. My name is in the description, so you can see it there. Marlon, do you want to add anything to that? Real quick.
We're definitely looking for any serious inquiries, like anybody who's really serious about trying to make a return on their money, but don't want to do all the investing that goes along, all the work that goes along with investing. We're definitely looking for people who are interested in just basically contributing and want to get a win-win situation. We mentioned win-win situations earlier, where a private lender is able to get like 10% return on their money over the course of a few months, then get all their capital back once the rehab project is over. And we're basically going to be replicating this exact thing. So we're doing a flip deal. If it takes 4 months, you get 4 months of larger return on your money. But ultimately, we're just trying to allow people opportunities to come invest with us and basically join in on the success that we've been having.
Yeah, definitely. I mean, real estate is a great way for everyone to win on a deal. And if we can help more people, win, I think this is a great platform for us to reach more people that might be listening and, be interested in that opportunity. So we're super excited for that. So yeah, if you are interested, just hit us up. And yeah, we're going to be providing more details about this in the future as we, establish it further and figure out more of the details about, terms and those kind of things. But yeah, so just stay tuned for that. We'll also be, plugging it more so in the future and, just to keep you updated on that. But yeah, building off of that, honestly, we believe that the biggest thing about private lending is the trust and credibility aspect of it. If someone doesn't trust you, then you can honestly forget about it. No one's going to lend you money. No one's lending money to anyone that they don't trust. So what you need to do is be building up your personal brand. Your personal brand is yourself, your knowledge, your experience, and how you present yourself. Everyone and everything has a brand. McDonald's has a brand, because the thing about McDonald's is you always know what you're going to get from them. You always know exactly the product. You know how the product is going to taste. You know exactly what to expect when you walk in. You know the smell to expect no matter where you are. McDonald's has that brand because they have established that. So that's in a sense what you need to be doing. And you can think of your brand by like how do people by what people say about you whenever they are referring you to someone or just talking about you in general. How do they refer to you when talking to others? What do they say? Are they saying, "Oh, that guy is funny as hell," or are they saying, "Man, that dude knows about real estate"? So look at it like that. Believe it or not, that is your brand. So honestly, you need to be building that up. And there's just certain individuals. It's gotten to the point in my business, especially, that there's just certain individuals that I just trust to do things without them having to prove anything to me. They are credible. So I just wanted to kind of touch on that. So some other financing methods, as we close out this podcast, we're going to kind of wrap it up with a few of the other financing methods that we think are also very viable options for people, depending on your situation. The first one the next one I'm going to kind of touch on is the home equity. So home equity is, in a sense, whenever you are tapping into the equity you have in your personal residence. So home equity comes in two forms, right? So you essentially can either borrow against the equity in your home at a very low interest rate through a HELOC or a home equity loan. A HELOC is a home equity line of credit. That's just a type of revolving account, like a credit card. So you pretty much borrow as much as you want up to the limit that they'll give you. You pay it back and then you borrow again. So it's like a line of credit in a sense. And you pay interest only on that amount borrowed. So it's just like a credit card. A home equity loan, on the other hand, is, in a sense, it's taken out all at once and paid back in installments. So that's like having a second mortgage.
Yep. I want to comment on this one. This is very big when I think about home equity lines of credit and like just borrowing against the value of your home. I always want to emphasize to people, especially, we mentioned this earlier too. People love to own homes free and clear. They feel like they just a positive stigma to that, like, oh, I own it. Oh, this is just mine. I don't have to make payments on it. You're not getting the best return on your equity that way. If your equity is pretty much sitting there in a home that's basically doing nothing for you. It's not adding any value to you. You're not making money on it. That's what the whole concept of Money Monopolizers is about, is how to make the best return on your money, how to get you towards financial freedom. And basically owning a home free and clear does not get you there at all. But I also want to say, because a lot of people will borrow against their home. I've heard this, actually. There was this on the radio. I heard one time this company called, I think, Equity Home Builders, and they basically were they were encouraging people to borrow against their home, basically to sign a mortgage with them or ask for a loan from Equity Home Builders in order to mortgage their home and then go spend the money on something stupid like a new car. So you basically are taking the money, the equity that you have in your home, and purchasing the liability that you have to pay for over the next 5, 6, 7 years. And now all that equity, and then on top of that, you still have to pay that mortgage back. So now you have new mortgage payments and a liability. That's the dumbest thing that you could do with your home equity line of credit or a home equity loan. Do not spend the home equity loan or line of credit on liabilities or expenses. This is a great way in order to get a down payment or money for repairs on an asset that's going to generate you income per month. Do not spend it on something that's going to lose you money per month and then have to pay that back as well, and have to pay back the home equity loan as well. That's the absolute worst way to go about using a home equity loan. And I think that you can borrow up to 75% of the value of the home, but you have to have at least 25% of the value already owned. So you can't. So say if you own a home free and clear, you only can borrow 75% of that. If you own 26% of the home, you only can borrow 1%, because you have to have at least 25% in there at all times as far as your personal equity in the home.
Yeah. Yeah, those are great points. If you, we're talking about this in terms of financing for real estate investment property. So if you take a home equity loan or line of credit out and you go buy a liability based off of what you heard here, wow, I'm sorry. I'm sorry that we told you about this then. That was my bad. But yeah, be smart with it. The next thing that we're going to want to talk about too, another way of financing deals is through partnerships. So partnerships is whenever two or more people come together to cover each other's shortcomings. In a sense, that's a way you can look at what partnerships are. So let's say, for example, that one person, or let's say you get two people that want to partner together, and one of those people is great at finding and analyzing deals, but they can't qualify for a loan. And the other person can qualify easily, but they can't find a deal. Those two people can partner together, and split those profits however way they agree to. There's a bunch of ways to structure partnerships. We're not going to get too much into detail of it, but this is a great way to finance. If there are, especially if you have a mentor. We talked about finding a mentor. This is a good opportunity to, utilize a mentor, and actually get some real estate investing experience. So that'd be a great first partner.
Yep. And actually, I like partnerships. That's one of my favorite ones, just because that's what we've been doing. Like me, you, then like our two businesses that we have. Those are partnerships. One of those three essential qualities to the table: the knowledge, or the hustle, the time, and the money. It's usually you bring one of those three things, and you can make a successful real estate deal. And that's what we've proven multiple times ourselves. And I know people are always thinking, oh, if I get in a partnership, I gotta share the profit. Well, think about it like this: 50% of a good deal is better than 100% of no deal. So you tell me what you rather have, because there's opportunity costs that come with trying to do everything yourself. You're going to be looking a whole lot longer, or may not even have the funds in order to get into something in the first place.
Yep, definitely. So I think there's a couple more that we're going to touch on and then close this out. The next one that we're going to kind of touch on is seller financing. So a lot of people haven't really heard of this, but seller financing is, in a sense, whenever someone owns a property free and clear, they can in a sense, lend to someone that wants to buy. So they become the bank. So if I own a property free and clear and someone wants to buy the house from me, I can lend I'm giving them my equity. I'm lending out my equity to them. So the mortgage is going to, in a sense, be paid to the seller every month instead of to the bank or a lender. So the way it'll work is the title will be transferred to your name, but the seller still has a lien on the property. So they're still the lender on it, in a sense. They're just, because they have the equity, they're pretty much just doing what they want with their equity and they're selling it. So so they have the lien on the property so that if you don't pay, then they can foreclose on you. So this is another one of those win-win situations for both parties. So the buyer and the seller both win in this. The buyer, it's a win for them because they can negotiate the terms such as the down payment, the interest, etc. That's going to make the deal work for them. And the seller, they're going to receive monthly passive income every month. That's also secured by an asset. So that's the beautiful thing about real estate. And when you're getting creative with it, there's so much security in it because everything, you can do these first position liens and you secure your loans with assets they're backed by properties so that, if they don't pay or they whatever, I can just take the property and sell it or do whatever I want. So it's so powerful and it's so also secure. And I think it's just a great way, for someone to get started. If you seller financing deals are a lot harder to find. You're not really going to see those just like on the MLS anywhere. Those are more, you got to put in work to find those. Cold calling and sending out letters and doing all types of things, trying to find those people that have that 100% equity in the house. You really got to get creative with it. But if you do make it work, it's beautiful, beautiful strategy. We haven't used it yet, but I am definitely, something is there's no reason we haven't yet. It's going to happen eventually.
Right. Yeah, I love seller financing too, just because the fact that you get to negotiate more terms, just like what I said with private lending earlier. And this time you're not trying to go to any type of lender or any type of bank in order to get a loan. You're literally just making payments to the seller. So say if you own a rental property, you're going to just be paying the seller. Well, actually, your tenant is going to be paying you, which you use that money to pay the seller. In this case, that way, now it's a win-win for you and the seller. You're making your cash flowing off the property, and then they're making their I guess you can consider those like mortgage payments. They're the ones that's collecting those mortgage checks per month now instead. It's a great way to have a problem solve. It's a great win-win situation for both the buyer and the seller in this case. And I think it's also a great approach in order to be a problem solver when you're going to potential sellers in general. So like Alex said, it's probably not going to be something you find on the MLS or like an on-market deal. You probably be going to different people, say somebody who's just looking to sell their house, don't want to deal with agents, don't want to deal with banks or anything like that. These are great people to target because they may not be looking to like I said, deal with those people, and then you can be somebody who solved their problems. They just want cash flow per month, and that's a great way for you to negotiate and be like, hey, I can get you X amount of dollars per month if you work with me, and I don't have to go to a bank. You can be the bank for me. Yeah. That's just a great way to get a lot more deals. And I think we can wrap this one up with our last way of financing deals, which is one of my personal favorites, is owner occupant investment properties. So with this is what both me and Alex have done, and as far as with our personal residences. As an owner occupant, you gain access to specialized loans that allow you to not come out of pocket a whole lot of money to get into different properties, basically. So the catch is that you have to live in them. That's why it's called owner occupant financing. It's a great strategy to access multiple different types of exit strategies, investment strategies, because of the low down payment loans. So a few of the loans that are out there, I think we mentioned them before, especially like in the house hacking episode, also with the buying versus renting episode. Conventional loans, actually, you can get as low as 3% down when you are using as an owner occupant loan. And then there's different programs that are government regulated as well. It's like the FHA loans, those go as low as 3.5% down. And then VA loans, which you can, if you're a veteran, you can basically get into a house for free. You have 0% down as far as your down payment to get into the deal. And this is very beneficial with if you're trying just to get into a deal and trying to do any type of investment without a lot of money out of pocket, because you can do things such as house hacking, like me and Alex have been doing, where we rent out a bedroom within we rent out bedrooms, or if you buy like a multiplex, you can rent out each unit within the multiplex and basically cash flow off of your rents, and that or get your mortgage paid down, whichever one you're able to do, and ultimately that allows you to live rent free or mortgage free. And another good strategy that a lot of people use when they use owner occupant loans is called live-in flips. So imagine purchasing a home, low down payment, doing a rehab while you live there. And then, so basically you're adding equity in the home just by doing value add while you live there. So you might have bought a semi-distressed property, fix it up, it appraises for a higher than what you bought it for, and then after a certain amount of time when you're done living there, you sell it and then make a profit off of that. And all you had to pay was 3% down with a conventional owner occupant loan. That's one of the benefits of being able to use an owner occupant type loan. So imagine $100,000 house you're trying to buy, all you need is $3,000 as opposed to $20,000 if you were doing a normal 20% conventional loan.
Yeah, and I think or another key thing about just to comment on the live and flip real quick, is the fact that you can defer the capital gains taxes because you lived in the house. Typically, when you flip a house, I mean, you're going to be paying pretty substantial amount of taxes on it, known as capital gains taxes, because it is income. But whenever you live there as a primary residence, you can pretty much defer those taxes, and you can take that whole gain tax free. And then what a lot of people could do from there is take that money and use it to catapult their investing career. You can use that money and, turn that into whatever you want, whatever you're interested in, 5 unit, 10 unit, whatever, get into more flips. It's a great strategy. Both of those, house hacking or live and flips, are great strategies, super powerful. You should check out episode 5 if you want to, hear more about house hacking in particular. Yeah. So, we have discussed various strategies today that we think are really going to help increase your ROI in any deal you try to do. And really, these are really, I think, powerful and unique financing opportunities or financing strategies. Sorry. So you can really employ any of these and, be successful with them, or you can get creative and even combine some of these. Maybe you can do a hard money and private lending in one deal, in the same deal. Maybe you can do a partnership and private lending in one deal, or you could do seller financing and a partnership on a down payment of a deal. There's so many different ways to, get creative. We could do a whole episode on creative financing, which we're not going to do. But it is, a possibility. So honestly, the way you should look at it is you want financing to be the least of your concerns, because at the end of the day, the financing is the factor that you can control. You have complete control over this factor at the end of the day. If you say you don't have enough money, well, you need to figure out how you can earn more money, how you can cut your expenses, or how you can save more money. It's all on you at the end of the day. So
Yeah. Just to finish up with this episode, I just want to reiterate, just as we started in the very beginning, if people are thinking that they can't get into investing because they weren't born rich, I hope we dispelled that for you, because there's a lot of ways to get into real estate investing without a lot of money starting out. You just have to be creative and find those different ways. We laid out a lot for you today. And basically, we wanted to dispel the myth of I can't and make you start thinking, how can I? So I hope y'all have been enjoying this series as much as we have, and hope y'all have learned some of the value.
So yeah, that is going to conclude this real estate series. This was a 6-part series, and I think we touched on a lot of important things that will really help you get started investing in real estate. If you really, are serious about this, go, listen to these episodes again and get the biggest takeaways from these and go take action on them. That's the biggest thing. After all of this, that's the biggest thing, is to take action, because it don't do you no good if you listen to all this and then you just, all right, got the knowledge, I'm good now. No, you can read, you can listen to as many podcasts as you want, you can get as much knowledge as you want. If you don't ever take action, then it's all for nothing. So that is it, though, for this episode of the Money Monopolizers podcast. New episodes will be released every Thursday and will be available on Apple Podcasts, Spotify, and YouTube. Just search Money Monopolizers wherever you listen to podcasts. We hope you learned something of value today. If you did, we'd appreciate it if you left us a review and rated us on Apple Podcasts. Seriously, we asked for it earlier. Please just take some time to, go leave that rating, that review. It's really going to help us. Like I said, we're really trying to grow this. So please, we'd really, really appreciate that. So you can find out more info about us on Twitter at The Monopolizers or on IG at Money Monopolizers. We post informative content on there that'll keep you engaged. So check that out and be sure to share them posts. But until then, we out of here.
You've been listening to the Money Monopolizers podcast, helping you take control of your financial destiny. To learn more about how you can be in control of your money, visit moneymonopolizers.com. We'll catch you next time when Alex and Marlon share more personal finance and wealth creation tips with you. Now it's time to take action.